Yeah, just a couple of things here on the economic front. First, we did have February wholesale inventories came out around 10 a.m. Eastern. They rose 0.2% versus the anticipated 0.3%. That's probably good news because the last 2 months, if you recall, wholesale inventories really jumped much higher than expected. And that can be negative if the inventories build up. Now, if they're building up in anticipation of increasing sales, that's one thing. But if inventories build up and the sales are not there, that can be a problem going forward. So it was good to see the wholesale inventories rise a little less than expected for February. Also, 2 o'clock today, we'll get the beige book out. That just kind of gives us a little bit of information a couple of weeks before the Fed meeting. So something to keep an eye out for. I'm sure traders will be looking at that. And we may get a little bit of a response from that report after 2 o'clock Eastern. As far as the reaction in the bond market so far today, we did have a move up earlier. We saw the 10-year Treasury yield open at 2.60%. We got as high as actually a little over 2.61%, but we have fallen back down to 2.59. This is an interesting area for a number of reasons. You can see, first of all, back in January, 255. So we got through that level. But when we saw the big drop start at the end of the second half of March, it began from about 260. You can see this big red filled candle. We went from 260 down to 235 in about 6 days. It's taken us 3 or 4 weeks, but now we've gotten all the way back up to that 260 level, right where the 50-day moving average is sitting. And you can also see the PPO moving back up close to the center line. So this is going to be an interesting area in the bond market. I think we've talked a lot about the stock market, the S&P 500 getting within 1% of its all-time high. Well, if the S&P needs a catalyst, maybe some additional money coming in to drive equity prices higher, it would certainly help to see money rotating away from treasuries. And as money rotates away from treasuries, the yield goes higher. We've seen that this past few weeks. Question is, can we continue to sustain it? This is about the area we rolled back over again. You can see early March, we got up to that PPO center line, rolled back over. We got just above the 50-day moving average, rolled back over. So I do think this is an interesting area to keep an eye out for. As far as earnings go, earnings season beginning to pick up. We have Netflix. We had Netflix report after the bell yesterday. They did beat on the top line. They beat on the bottom line. They raised their subscriber. Well, they didn't raise their subscriber guidance. They actually beat, and I think reported record number of subscribers in their prior quarter. But they lowered guidance going forward. And in the same breath, they said that Disney Plus would not have any material impact on their business. But they lowered guidance, so you be the judge. Anyhow, IBM, you can see, also reported strong numbers. Really, the one thing, the takeaway for me is that most of these companies beat on the bottom line. And that was a big concern coming into earnings season. Were we going to see a lot of disappointments? So far, I'd say the numbers have been pretty good. Even in the banking space, you can see U.S. Bancorp there toward the bottom of the list, only matched expectations. But some of the big banks have done pretty well in an environment where we've seen that 10-year Treasury yield dropping. So not bad, really, if you think about it, because as Treasury yields rise, if they rise in the next quarter, that should really be a tailwind for many of these banks and for the financials in general. All right, those are the companies that are coming up after the bell. You can see a number of stocks. I do want to point out, even though it's probably only about a $10 billion company, maybe $12 billion, Atlassian Corp, TEAM, ticker symbol TEAM, that's been one of the strong software stocks in the market. And I'm kind of interested to see how one of the first software companies reports, because there's a lot of growth built into these companies. And we'll see, I'll get a glimpse at least after the bell tonight, how that group maybe is beginning to stack up. Okay, let's head in. I do want to first go into Qualcomm. Before I look at some of these companies that reported earnings, I want to show you this intraday chart. This is a 5-day, 10-minute chart. I think you can see something happened in the final hour, and that something was the announcement that they were settling their dispute with Apple. And the market clearly said Qualcomm is the winner in this settlement, because if we pull up Apple and look at the same chart, you'll see that at 3 o'clock yesterday, we had a little bit of volatility, but really not a whole lot of action in either direction. Apple has moved up higher today, But Qualcomm up $20 in 2 days. I think pretty clearly that is, and from a $58 price level, anyone owning Qualcomm and not really paying attention and just waiting perhaps to the end of the month to get their statement is going to be pleasantly surprised when they see what Qualcomm has done. As far as some of the earnings reports, let's pull up Netflix first. That's obviously one that was widely anticipated. And you can see still in a trading range. Remember the huge move Netflix made back in to open up 2019? Off of that December low through the first part of January, I remember touting Netflix and saying, wow, this one's been a tremendous leader during this initial rally off the bottom in what I thought at that time was just a bear market rally. Turned out to be a lot more than that. But when you look back now, 4 months later or 3 months later, middle of January to middle of April, Netflix really has gone nowhere. We topped out near 360, and we are currently trading at 356. So Netflix, while it did show some really nice relative strength at the beginning of the year, that has died off. And it shows here when you look at Netflix relative to the internet space, big move up. And then we've been drifting lower ever since for the last 3 months. So on an absolute basis, we're going sideways. But on a relative basis, money's been rotating away from Netflix. That's not good. IBM. I actually thought IBM might report a pretty good number this quarter. The stock was trading pretty well. We had gapped up with earnings back in January, continued moving higher. You can see relative to business services, the stock had reached a peak back in January, but still was holding up pretty well on a relative basis. But we did not get the number, or at least the market didn't see the numbers that it was anticipating, that it wanted to see. Stock gap down earlier today. We'll see how it closes. A nice hollow candle here and a move back up to the 50-day would certainly be a good start to repairing the damage from today's open, but a move back down and a close toward the lower end of the day would not, lower end of today's candle would not be good news here. CSX reported. CSX did beat, as I showed. This is a breakout, and I want to point out the railroads. You know, I mentioned, I think yesterday, the day before, J.B. Hunt not doing well, truckers not doing well. That is not the case with railroads. Railroads have been breaking out, and if you look on a relative basis, railroads continue to outperform the S&P 500. When we look at CSX, it's outperforming the S&P, but it's not exactly been doing great versus the railroads. It has moved up now to at least currently to a 2019 relative high versus the railroads. So that's good news. We're getting a breakout. That's good news. But up until this report, there had been some other railroads outperforming CSX. Pepsi, mentioned this one at the top of the show. Here's your breakout on Pepsi. And the soft drink index moving higher. Pepsi, and I remember talking about Pepsi versus Coke and saying Pepsi was a much better trade based on relative strength. Well, here it came through on the earnings report. Big move to the upside on Pepsi. They beat top line, bottom line, continuing to move higher. One other stock I want to mention, I'm going to turn it over to Erin for upgrades and downgrades. Talked recently about Morgan Stanley, how this one looked like it was going through a character change. We had moved up, taken out these highs, pulled back, held the 20-day, gapped up, big volume, putting in new highs. On a relative basis, look over the past 2 months what's going on here. Morgan Stanley relative to investment services. Then today, they come out with their earnings news. They beat on their top line. A pretty easy beat, by the way, $10.29 billion versus $9.96 billion. Easy beat on the bottom line, $1.33 versus $1.17. And the stock now breaking out on both an absolute basis and a relative basis, which I think is really critical here. I like Morgan Stanley. I suspect that if the financials do perform well in the second quarter, and if that 10-year Treasury yield continues to rise, I look for Morgan Stanley to be a real leader here in this quarter. Okay, Erin, upgrades, downgrades, what do you have for today?
All righty. You know, honestly, as far as the lists go, the downgrades far exceeded the upgrades today. I'm kind of wondering, I'm almost thinking about keeping a chart, just my own little indicator, and just see if the amount of upgrades versus downgrades means anything. I don't know about that. But anyway, our first one is going to be Domino's Pizza. It was upgraded today by Morgan Stanley from an equal weight to an overweight. I noticed this nice cup shape or rounded bottom. I had the PMO buy signal come in at the end of March, which was very timely. At this point, what I noticed is we have this gap. and we've already started to cover it, and there's about 2.5% more to go to actually get it completely covered. And the next area of overhead resistance I would look at is this November-December high. And, you know, that's a pretty nice move to the upside. I do like the upgrade. I think Morgan Stanley was on par, really caught that one. Total System Services, TSS, was upgraded by Goldman today from a neutral to a buy. They raised their target from $98 to $115. And, you know, it's already broken out above the September high. It's been in a really nice rising trend channel. I mean, just great, not too, excuse me, not too steep, certainly something that could be maintained. But then we got that little breakout today to the upside from that rising trend channel. And I think that's quite promising. PMO buy signal came in earlier this month. And look at OBV volume going along for the ride with that rally. You could see all of those nice black bars on volume. So I like Total System Services. Be a little concerned about chasing it right now. Certainly something I would continue to hold if I were fortunate enough to hold it. Yamata Gold was downgraded today, and I'm not surprised. Gold, I'm very bearish on. I wrote about it last night. A lot of bad signs coming on gold. And so I'm not surprised to see one of the miners not doing so well. Yamata Gold is looking at a downgrade from GMP Securities from a buy to a hold. So they're moving it to a neutral, but I have to say I would be looking for $2 at this point. We're getting ready to hit what could be some, you know, a slight support area based on that October low, but I would be looking closer at that $2 area. Notice the PMO has been in decline ever since we started this symmetrical triangle. Typically they are continuation patterns, but certainly it did not break to the upside as you would want to see. So we've got the breakdown out of that symmetrical triangle. And as I said, I would be looking for a drop all the way down to $2. Everything is pointing that direction, including price. Chubb was downgraded today by Morgan Stanley from an overweight to an equal weight. Look at the PMO, and that's clearly because of what happened or is happening currently today. It's down 1.75% on that downgrade. It is sitting on the 20-day EMA. There's a little bit of hope here, and the PMO had been turning up. It looked like it might want to resume this rising trend. And, you know, if we come in here and draw the rising bottoms trend line, I think that is helpful. We can see right here, I'm going to come from here for now, just because I want to look at a little bit shorter term rising bottoms trend line. We haven't actually hit that. But if you look in the shorter term, we have another trend line you could draw out of here, and we still haven't hit that yet. So there's still a little bit of areas of support. Of course, the 20-day EMA. You know, the PMO did turn down, but we're looking at a really difficult price drop today. So I think that this one, you know, while it doesn't look great, I don't think it's that bad either. All right, Comerica. This is looking okay. It was downgraded today by two different agencies. One was Raymond James, which downgraded it from a strong buy to an outperform. So, you know, it moved to an outperform, even though it was downgraded. So that still is pretty good. Jefferies downgraded it from a buy to a hold. So that went into a neutral. As far as Raymond James, they've moved their target to $87. Because, of course, like I said, it's still going to an outperform, but they lowered it from 92. So they're still looking for a move to the upside. Jefferies has lowered theirs to 84. And like I said, they're at a hold now. So both of those targets are still higher. PMO has got a buy signal. Everything else looks good here. So when I saw it on the downgrade and looked at the chart, I was kind of wondering what was going on. And then, you know, I found out why. They moved to a neutral and to an outperform. All right, last one really quick, Texas Instruments. And TX, and Longbow downgraded it today from a buy to a neutral. This one is looking fairly decent. You know, we had the PMO buy signal, but the PMO was already starting to decelerate on this rising trend anyway. So now we're starting to see that rising trend possibly breaking down. I would suspect it will. This is a pretty good area of support, though. If it can hold that 114 level, I guess, yeah, 114, right around there, I think that would be good. It could make that move back up, but you know, it was downgraded here today, and the PMO is starting to turn down. So that's all I have for upgrades and downgrades. Here is the listing of what I did talk about. A couple that you might be interested in as far as upgrades: Holly Systems, Goldman Sachs, and downgrades. Additionally, Chipotle, JB Hunt, Lennar, and DH Horton, both downgraded, Skyworks, and Shake Shack. All right. Tom McClellan is here, so let us get right on into his presentation. Tom, we can't wait. Welcome back to the show.
Well, thank you.
So I'm going to just pass the screen to you, and let's go ahead and get started. I'm dying to hear what you have to say.
Okay. I'm waiting for the switchology to take place.
Mm-hmm.
If I need to do something, let me know.
All righty, let's see. Just go ahead and share your screen. We should be able to get to it pretty quick here.
All right. Glad to have somebody smart who can talk me through this.
Well, thank you for that compliment. All right, there you go. It's in.
Well, the theme for today is that gobs of breath is good. And we've been seeing that. And it says that liquidity is plentiful, and that is a condition that tends to persist for a while. Before I get to the breadth numbers, though, I want to talk a little bit about the stock market's relationship with crude oil, which is kind of fascinating because the big drop in crude oil prices that we saw in Q4 really dragged the stock market down in sympathy. And then the rebound in crude oil prices in Q1 and into Q2 has matched the rebound in the stock market. So you think, oh, okay, all I've got to know is whatever crude oil is doing, and that's what the stock market's going to do. Well, that works some of the time, but you find that throughout history, every once in a while, they go through this inverse correlation where suddenly the nice, perfect correlation of Dan steps flips and becomes inverted. And then it flips back without warning. And I wish I could figure out who is controlling the switch on that, but I haven't figured that out. The place that crude oil appears to have stopped is an interesting spot because not only was it the lows during last summer, but it's at the level of an apex of the triangle that we saw in early 2018. Apex behavior is really interesting in charts. The price level of an apex can have future importance, both in time and in price. In the case of that apex, it marked the top in about May of 2018, but that the level of the apex also established a new important support and resistance level for crude oil prices that hadn't really existed before. And so now we're finally back up to that. We're going to see if we can get through it. It may take a while banging on the ceiling before we can get through it. Reemphasizing this point about the binary condition of this behavior, here's a look at 2015 to 2017, just to see that sometimes it's a positive correlation, then sometimes it's an inverse correlation, then it's back to positive, then it's back to inverse. So once you think you've figured it out, it'll flip on you. And it's not, and I once thought there was a useful cyclicality where the spacing of how long it was positive versus inverse was kind of consistent. It's not really. I wish that was the case because then I could figure out when it was going to flip again. But I have not unlocked the secret of why that operates that way. As interesting as it is that stock prices correlate with crude oil prices in real time, they also correlate with a 10-year lag. This is a leading indication that I've shown before on your show. What I've done in this chart is I've taken the log scale price of crude oil, that's on the top, and I've shifted that forward 10 years to reveal that the movements of the stock market now are echoing the dance steps that crude oil was doing 10 years before. Now, it's not always exactly 10.0 years. Sometimes it's 9.5, sometimes it's 10.5. There's a little bit of what I call accordioning in the alignment of the tops and bottoms, but the dance steps really are still there. A little over 10 years ago, we had this enormous decline in crude oil prices. We didn't see quite the same enormity of the decline in the stock market, but it was still there, right on schedule. And now we're rebounding, just like oil prices did out of that 2009 low. Sometime around 2021, we should get a top and a long broadening pattern. I think that right now, being a trend follower is great. After about 2021, being a market timer is going to be what you're going to want to do, because trends are not going to be there. And then when we get out to 2024, that's when the ugliness starts. So whoever gets elected in 2024, whoever that is going to get blamed for the stock market echoing this decline that's already baked in. It's already sized up on the tape recorder here. We're just waiting for that loop of tape to reach the playing head, and then we get that. Here's a longer term view of that same phenomenon. This is crude oil prices shifted forward by 10 years and compared to the stock market. And this is a phenomenon that doesn't really make any sense at all. I mean, how would crude oil know 10 years in advance what the stock market's going to do? It doesn't really have to make sense, though, when you factor in that it's been working for the entire history of the Dow Jones Industrial Average since 1896. And so at some point you say, well, I don't know why it's working, but it works well enough that I can probably have some good faith in it. The theme for today is breadth. Gobs of breadth is great. And so here is the New York Stock Exchange advanced decline line. It's looking at all of the issues traded on the NYSE, and this is the one I usually prefer to look at. It's already been making a new all-time high. It's above its highs of August and September of last year. The Dow Jones Industrial Average and the S&P have not yet exceeded their equivalent high. So the advanced decline line is stronger. And that's a really good thing. In fact, it started showing strength earlier. It was making a higher high here. It broke its down trend line ahead of prices. So it's really saying that there's lots of strength. And the thing that you need to know about the advanced decline line is that it's a very egalitarian indicator. Every issue on the whole stock exchange gets the same vote. It doesn't matter what your market capitalization is. And so that's why it's so useful, because it can tell you something different from what the price cap weighted indexes are saying. And it's also made up mostly of small issues. You know, there's a lot of big cap issues that drive the major indices, but there's not that many of them. And so when you take the votes of the populace and find out what they're all doing, you can find out if liquidity is doing well or if it's doing poorly. We saw back in September that the advanced decline line made a small divergence, warning of the trouble that was coming, and sure enough, we got trouble. And then it made a bullish divergence, making a higher high coming out of that low, confirming that the strength of the new uptrend. One of the big issues that I get asked about a lot is about the different types of issues on the NYSE. And so here's a breakdown of the issues as we track them. We look at all 3,000 plus issues listed on the NYSE. And some people will tell you, well, you really ought to look at only the common stocks, or only the common only advanced decline line, because those are the real stocks. And so that's what you should look at. You should get rid of all the other impurities and other messiness that contaminate the numbers, and just look at this. That's what they tell you. And it's a hypothesis that makes sense, but it's not a hypothesis which survives contact with the data. So here's a comparison. This is the composite NYSE AD line on the top. That's all the issues. And here's a common only advanced decline line, just looking at only the common stocks. And what you find out is that when the two of them disagree, you really ought to be listening to the composite. That the common only version doesn't give you better answers. In fact, it was still making higher highs back in September along with prices, even though we had a divergence in the composite version. And right now it's not making a higher high above last September and above January. So you might say, well, that's a big divergence, but the composite version is saying, oh no, everything's fine. So it's a really a peculiar situation where the hypothesis is that you ought to look at the purified stuff and because that's the best value, but it really turns out not to be true. It's like the chaff is worth more than the wheat. And so we like to look at some of those other things that are in there. And so here is, for example, preferred stocks. It turns out not to be a very good advanced decline line. It doesn't give you warnings when you'd want them. It'll be making higher highs, and then you get a big sell-off. Making higher highs, and then you get a big sell-off. It never gave us a warning of the big decline last year, and so it's not that good. It doesn't hurt anything, but it's just not the best indicator. What we do find is that the types of issues that are most often blamed for contaminating lists is the bond closed-end funds. There's a couple hundred of those, and they tend to be the best indicator ever. They are just the best detectors of good or bad liquidity. They're the canaries you want to hire to work in your coal mine, because when liquidity starts to dry up, they'll show it. This was one of the few places we got a divergence back at the January 2018 top. It shows us a divergence at the September top. And then it showed us strength at the December bottom. It was making higher lows, and it's been showing us gonzo strength all the time during the uptrend. No sign of weakening yet, no trouble, no worries in regard to liquidity, and this should give us a nice early warning. I'm sorry that I can't direct you to any place where people could watch that themselves. We track this data ourselves and publish it when it has something useful to say, and I don't know of a source where anybody else can get it, because it's kind of a pain to track all 3,000 plus stocks and sort them out into different bins that can tell you useful answers. One other way that you can track a similar data, there is an advanced decline statistics that FINRA publishes on corporate high yield bonds and also corporate high grade bonds. So here's an advanced decline line that we track based on this data from FINRA. And if you want to take a screenshot of that so you can grab the link to where you can get that data every day, they don't make it available in a historical data series. So you have to go in every day and fetch the data yourself. But it's such useful data that it's really, really good to track. So here we saw 2016. The high yield bonds were doing absolutely wonderful. They were saying liquidity is really plentiful, that even these least deserving issues could get enough of it. They were disagreeing with prices at the election, and sure enough, they were right. We saw big strength. They were disagreeing, though, with prices at the January 2018 top. They were saying, uh-oh, liquidity is in trouble, and sure enough, we had a problem. They showed another divergence at the September top in 2018, said liquidity is in trouble, and sure enough, they went down as prices went down in the stock market. But then they flipped and said, uh-oh, liquidity is back. Strong uptrend starting, and they're still saying that. It just keeps on pushing higher at a very steep rate. That's a message that liquidity is so plentiful that even the junk bonds can get some, and that usually means that there's plenty of liquidity to go around to lift up the rest of the overall stock market. Now, seeing liquidity and strength in the stock market is what's supposed to be happening. We're in the third year of the current presidential term. I like to measure these years as beginning November 1st instead of January 1st, and that's because the election is held in November. And so here we are with a presidential cycle pattern which averages together the S&P 500 in 4-year chunks of time. We're in the middle of the third year, and sure enough, we're following the dance steps of its pattern. When we get to early May, it says that there should be a temporary top and a little bit of a scary decline to mid-May. I'm betting that the decline will feel scarier than it actually is, and that'll serve a useful purpose to get people scared out of the market, so that then we can get in a nice short-term low and then start powering higher again. But for now, until about the end of April, early May, it's still an uptrend, and we expect the S&P 500 to follow suit. Here's a longer-term view of that same presidential cycle pattern indicator. It didn't do that well as a forecaster of what the stock market was going to do during the first 2 years of President Trump's term. And my best explanation for why that is President Trump has been a different kind of president than we've ever had before. He's starting to become more a swamp dweller and more like the way that presidents and political calendars operate. And so we're seeing the stock market fall more into line with what this average pattern says. But generally speaking, the third year is a steep up year. The fourth year, or the election year, is also an up year on average, although not as steeply, because people start worrying about the next election and what that's going to mean for stock prices. Erin mentioned, here's on that same topic of the third year, here's a comparison of the current S&P 500 to what we saw in the first 3 years of President Clinton's term in office. And very, very strong correlation between the two. It got a little bit out of whack in the Q4 of 2018 when oil prices led stocks lower, but now the two are dancing back together again. There's a little bottom that's due this week that we saw in 1995. Slight pullback wouldn't bother anything, and then we get back to following the uptrend again, assuming that we continue to match this pattern. Erin mentioned the breakdown in gold, and here's the chart of June gold futures. This is current through yesterday, so it doesn't have today's price action on it. But what we're seeing is a big head and shoulder structure that has now finally been broken. The importance of a head and shoulder structure is not that it is definitely a top or a bottom. It's an important structure only when you get confirmation, and the confirmation of a head and shoulders top is when the neckline gets broken. And that happened with some authority on Tuesday. It got broken and saw it close all the way down below 1280. That neckline is about 1290. And the reason this is important is that then it creates a measuring objective. So you take the height of the head above the neckline, whatever that distance is, you take that same distance and apply it from the point of the break downward, and that's where your downside objective is, which is around 1225. It's not going to get there all in one day. Probably going to take a month or two to get that work done. But so that's the objective. Now, don't make the mistake of thinking that an objective is a guarantee. It's not. An objective's purpose is to tell you when to cover once the price reaches there. It could go beyond there. The breakdown could fail and it could turn up, so you have to have stops in place to manage that. But that's the expectation from the structure. What's also interesting is that as gold prices have broken important support, we also saw similar breaking of support in silver. This is the May silver contract, again, current only through Tuesday. It had important overhead resistance at 15, which was continued in late 2018. That overhead resistance turned into support, but now it's been broken. The downtrend line is intact. So we have an intact downtrend with lower highs and lower lows, and the support has been broken. So silver is confirming the breakdown in gold, and that says not very good things about the prospects for the precious metals complex. Turning a little bit to interest rates, the Fed, by all accounts, appears to be on pause, and that's as it should be. This is a comparison of the Fed funds rate, that's the black line, versus the 2-year Treasury note yield, which is the green line. And I've been advocating for a long time that the FOMC ought to outsource the job of setting interest rate policy to the 2-year note yield. We've got all those 12 PhDs sitting on a committee arguing with each other about what the economy is doing. Well, if they just would listen to the 2-year note yield, they would likely get a better answer. When the Fed gets behind and the 2-year note yield is going up and the Fed doesn't raise rates as quickly, well, then you get things like the housing bubble and you get the internet bubble. And then the last decade or so, we've got the everything bubble when asset prices of all types are being inflated. Right now, we've finally gotten these two, they're back into balance. And if the Fed could manage to keep them right on top of each other, then we would not have an overstimulus or an understimulus. We wouldn't have the problems of creating the 2007 bear market that the Fed had by being asleep at the switch and not cutting rates fast enough and soon enough. They also gave us a problem with the collapse of the internet bubble being worse than it needed to because they were asleep at the switch. So hopefully they won't be asleep at the switch this time. But based on their long track record, that's not really something that you can base a plan on. That hope, as my old boss in the military said, in military operations and in birth control, hope is not a strategy. So hoping that the Fed will always do the right thing is not the basis of a sound plan. But for right now, they're back in balance, and that's a useful thing because liquidity is plentiful and the Fed's not stomping on it. So we can continue to have the third-year bull market just like we're supposed to. Now, I can go back through any of these charts if we want to answer questions, but I figured I'd give you a pitch. If people want to learn more about the work that we do, come to our website. You can sign up for one of our subscription products. You can sign up for our free weekly chart and focus letters, which also get posted to the Top Advisors Corner on StockCharts.com if you want to read them there. No strings attached if you sign up for the chart and focus. We don't send you any spam or any offers or anything. It's just a way to get more people acquainted with our work. And with that, I'll toss it back to you guys.
All right. Sounds good, Tom. First of all, great presentation. Really enjoyed it. Some of those charts amaze me every time you come on here. The fact, especially like you said, crude oil prices, overlaying those 10 years later to what the stock market's doing makes no sense to me whatsoever. But it's amazing how closely the two are tied.
And, lots of things in the stock market aren't required to make sense. It would be nice if they would, but you don't have to understand why electricity works in order to turn on the light switch and illuminate the room. You don't have to understand the linkage of crude oil prices to stock prices over 10 years in order to see that it works and to get the answers about what lies ahead.
Yep. All right. Good enough. All right. I got a question for you on gold. You mentioned that you pointed out the head and shoulders breakdown. I too was watching that 1280 level and saw that we had broken down on the price of gold. Yesterday we closed at 1277. So we definitely got the breakdown. You can see with the gold futures, yeah, that chart that you're showing there. So short term or short to intermediate term, you're looking for that move back down to your objective there just above the 1220 level. Do you have any longer term predictions on gold? Do you have any thoughts on that?
I do, and they're very bullish, actually. I didn't bring a chart, but one of the fun discoveries came from looking at the price of uranium. You think, uranium? What? Why would anybody care about the price of uranium unless you're running a nuclear reactor in your backyard, which I'm not, but I don't want that rumor to get out. But it turns out that the price movements in uranium tend to lead gold prices by about 7 months, which, again, is ridiculous. It doesn't make any sense. Shouldn't work that way. But, after you see it working for long enough, you finally accept it. Uranium prices have been moving up, and so that should create a bullish uplift for gold prices once gold gets done with the mission of doing whatever it's going to do with its head and shoulder structure. So that could be a temporary interruption in terms of gold answering the bell from uranium and heading higher, but eventually that should work, and uranium prices should lead the way for gold prices to head higher.
Awesome. Another question. This one came in from the room. Well, the question is the crash in small caps today a concern? I don't know that I would call it a crash. It is down about 1%. It's certainly down more than the other indices. But I would just say this. Are you concerned at all about the fact that small caps over the past couple of months, and really even going back further than that, have been underperforming the S&P 500? Because we do have, I know a number of your charts was suggesting that, we're going to go higher, but a lot of these small cap companies do all, or certainly most of their business, if not all of their business here in the U.S., and seeing the small caps underperform, that is one thing that bothers me a little bit. I'd rather see the small caps outperform. Does it bother you at all? Or are you watching the small caps and what they've been doing recently?
That's a short answer. Yes, it's a bother. It does bother me. It's not necessarily fatal, but it's definitely not good news. The overall market tends to do the best when small caps are leading, and especially when small cap growth is leading, or the Russell 2000 Growth Index, which you can track with IWO. If that is leading the way, then that says liquidity is in the best possible condition, and that liquidity is going to flow everywhere and help everything. When it's not working that way, the major averages can still head higher, but it is a concern. It is a concern that can get itself resolved, and so for now, it's not a signal. It's not a definite. It's just a condition. It's not a signal, but it is a concern.
Mm-hmm. Yeah, no doubt about it. And I'll say, leading into throughout 2018, we were getting that strength in the small caps on a relative basis first half of the year. And when the small caps fell apart the second half of the year, that's when, of course, the overall market took a pretty big hit. But we had rallied back the first 2 months of the year on the small caps. And it just seems like we've kind of given up that relative strength here over the past 6-7 weeks. So I certainly understand the question that was coming in. Another question that came in, did any of Tom's charts or research predict the 2018 year-end decline? So in the fourth quarter, with that huge drop, was there any of the things you talked about that you feel kind of, might have indicated we were going to see that kind of weakness?
Well, I'm showing the comparison of crude oil 10 years forward to the Dow, and for about the last 9 years, I was wondering what the Dow was going to do to replicate or not this big decline that we saw in crude oil prices back in 2008. It was an absolute crash. I don't know if everybody remembers, but crude oil went up to $145 a barrel for about a day, and then it crashed all the way down to 37. And so it was a huge event. Part of that came about because in 2008, the stock market wasn't working as an investment. And so everybody said, hey, let's all pile into commodity index investing. And so you had all sorts of hedge funds that were buying baskets of commodities. And so it was a very weird condition in early 2008 when you would see rice prices and nickel prices being in positive correlation, which makes no sense. Those are unrelated markets, not attached to anything, but they started moving together. And that's because people were pouring money into these commodity baskets and driving up all the prices of all the commodities, because that was what the current fashion was back then. That resulted in a big blow off top in June 2018. And so because that was so far above trend, you had to balance it out by going so far below trend with the bottom in January 2009. These are monthly closing basis. And so the question that I had for about 9 years is, are we going to see the same magnitude of a decline in the stock market to match that? And that's a reasonable question, because there have been other events in the crude oil market that have not shown up in the stock market. Back in 1990, crude oil prices went from 22 all the way up to 40, and then back to 22 again because Saddam Hussein and the Republican Guards Army annexed the 19th province, which we know of as Kuwait, and that caused oil prices to double. Well, we did not see that oil price event happen and get replicated in the stock market 10 years later. This didn't show up. So if you put your thumb over this spike, then the correlation was still working. It's just that this was an exogenous event in the oil market, not a real supply-demand message. And so that's why it didn't flow through into the stock market. So that's the question I'd had for 9 years was this big decline, was that the same sort of exogenous event and not a supply-demand message? And how is it going to relate to the stock market decline? We did see the big sharp decline in the stock market. It just wasn't of the same magnitude of giving up 75% of the value, but it was still right there and right on time. And then we saw the oversold bottom in December, a month early versus this 10-year leading indication. And now we're in the rebound phase that crude oil says, and that should continue into 2021. So yes, that was the one thing that forecasted it best, but it was really hard to read because of not understanding how could the stock market replicate that.
Yeah, and I think too, if you go back, like you said, kind of put your thumb over that 2008 peak in oil and the 2009 decline, just kind of take both thumbs and cover that up. You do have a steady uptrend from 2006 through 2014 that, looking forward on the S&P 500, maybe that means we're going to, or on the Dow, depending on what you're looking at, but would seem to indicate that maybe we are going to see that continuing rise for the next 4 or 5 years. And the other thing that this is interesting, or I think makes this interesting, Tom, is it kind of lines up with the time frames of many of these secular bull markets that we've been in, where you go up, 17, 18 years. I mean, if you consider that the bottom was in March of 2009 and you go out, 15 years to your 2024, 2025, that would take you out about 15 or 16 years, which is pretty close to the length of some of the prior secular bull markets. I don't know if you had thought about that at all.
I haven't thought about that as much, but I'll take it. If we're going to see stock prices do exactly what crude oil did, then we can look forward to a top in 2021 and then a long sideways period of choppiness, which again, that'll be a great time for market timers. Buy low, sell high, buy low, sell high, rinse and repeat, and then that'll work until we get to about 2024, and then oil prices had their big decline, and I think that's going to be a real problem for whoever gets elected president in 2024. They're going to be dealing with a big crisis, and they're going to get blamed for it. But then it'll all rebound starting in 2026. So write those dates down and put them on your calendar, or just subscribe to our newsletter, and you get to see the chart periodically, and we'll talk about it as it's happening.
Yep, and as crude oil prices goes up and down, in addition to the short-term impact that it's having at the pump when you go to get gas, it also is having an impact on your portfolio 10 years down the road. So definitely keep that in mind. There was one other question in the room, and that was, how can I get the bond CEF AD line? I think you were talking about that earlier in your presentation. Is that something that the viewers can get a hold of?
It's something that we calculate ourselves, and it's something that we feature in our newsletter when it has something useful to say, like it does right now. And so that's the only way I know to get it, aside from distilling all 3,000 stocks in the NYSE yourself and counting up what they do. And it takes a lot of programming work, which I was willing to invest in because it really gives a cool indicator that gives great insights. But that's the only way that I know of to do it. You can approximate it by looking at some of the junk bond ETFs. So, for example, JNK or HYG, they are going to show strength and they're going to show weakness. It's not going to be exactly the same as this advanced decline line, and they're going to be cap weighted from some of their bigger issues. So that's going to skew it versus a more egalitarian, every man gets a vote kind of an indicator. But they are well known for showing divergences at important tops. They're not as well known for showing divergences at bottoms, but when you are seeing junk bond strength in those, that can be somewhat of the same message.
Okay. Does it bother you at all looking at this chart that your AD line there is just starting to roll over with the S&P 500 going higher, or do you need more information than just that little tick down?
It's saying this is something to watch, but it's not saying that this is a problem yet.
Okay.
We need a divergence over a little bit longer duration than just a week in order for it to be meaningful. And so it could be just a momentary anomaly.
Okay. One last question, then I'm gonna let you go. If we do in fact go higher in the S&P 500, and certainly a lot of what you pointed out here points to that, what does Tom McClellan do in the stock market? I mean, do you look for relative strength to kind of guide you where you want to be in the market, or do you trade ETFs? How do you approach the stock market?
With ETFs and mutual funds, and we're long the S&P 500 right now, and our managed account program that we sub-advise, it's done at a different firm. And then the nice thing about that is that I don't have to register with the SEC and have them knock on my door and do an audit. Somebody else gets that headache, but we still get to engage in the money management business. And if people want to find out more information about that, it's on our website. That's what I'm doing. My focus is on trying to figure out what the overall stock market is going to do, more so than looking at individual stocks, because I think that there's better answers for the overall stock market than there are for individual stocks. So that's where I put my focus.
Makes sense. All right. It's always a pleasure to have you on here, Tom. Really appreciate you stopping by today, and we look forward to having you back on Market Watchers Live soon.
Sounds great.
All right. Thanks so much. All right. And there he goes. I tell you, Erin, those are some of the most interesting charts that I think I've ever seen, especially the crude oil versus that long-term relationship between the crude oil prices 10 years ago and the equity markets today. There are some amazing relationships. And as Tom pointed out, I mean, it's not like it just, we're just looking at the last 5 years. You can always pigeonhole things like that. But you go back and look over time, there's a lot of positive correlation between the two. So something to certainly keep an eye on.
Yeah, he always has some very interesting views, and the charts, the way he correlates things. I always love it, Tom, when he comes on. And if he's still here, just so you know, I always love it when you come on, Tom.
I'm sure he knows it. I know you all have been friends.
Okay.
Okay.
I should have a 10 and 10 for you here.
Okay.
Because it is that time already. Here is the RRG, looking a little bit messy. Notice we didn't have that many requests today, so your request may very well get answered. Usually that means we have an excellent guest or a really great workshop. So I always, I feel good when I don't see that many requests, actually. Technology, the big winner today, and a couple of ETFs. We'll probably look at one or two of those. Let's get started, though, with CPRI, Capri Holdings.
Sounds good. All right. I have some issues here with CPRI, and you can see the red arrows marking this $50 level. After gapping down below $50, you can see multiple reaction highs. But I probably could have put another arrow in just maybe a week or so after that initial gap down. But we have tried to get through $50 multiple times. Just a week ago, we had a bearish engulfing candle right at $50. So I don't think there's any doubt we need to get through $50. Now, the good news here is that the clothing and accessories group is moving to new highs. And yesterday I was talking about it, wanted to see us get a relative breakout versus the S&P 500. And we appear to be getting that today. So clothing and accessories having a very, very strong day today. So on a relative basis, we're getting a breakout. Now can CPRI, which has not been a great stock relative to the group. So I wouldn't be interested in this stock even if the group is doing well, because it isn't one of the best performers. So I drew these relative lines on here, something to watch for on CPRI. Assuming that clothing and accessory stocks continue to perform well on a relative basis, we need to get relative breakouts. We want CPRI to begin to outperform a group that is outperforming the S&P 500. So far, we don't have that. So I like the group, but I think there are candidates in that group to consider long before CPRI, at least until we see a breakout above that $50 and get some volume coming in to support it.
All right. The most popular in the chat room happens to be DOMO. I know it was your Monday setup last week, I think, not this week.
Yeah, this one I'm kind of watching pretty closely, because this whole 36 to 37 area, well, 37 and a half, that was an area that I'm kind of monitoring pretty closely. I still own the stock, but I may take a loss if it goes much below where it is currently. 50-day moving average sitting at 35.99. It has worked its way back down there. But just to show you how volatile a stock like this is, 2 days ago, it had gone up, or excuse me, about a week ago, it had gone up to $40. And I actually got out. I took profits, came back down. I did get back in around that 37.50 level. I was considering a second entry at 36. I haven't done that yet. I may just wait and see how the stock closes today. So for me personally, it's definitely one that I'm keeping an eye on. I think going down below that intraday low, below $35, that would be my absolute final line in the sand. Because on all of this volume, after gapping up, we saw intraday selling and buying came back in on very heavy volume at that 34 and change level. I'm not sure what that number is, but that would be a line in the sand to me. I do not want to see a close below that that support level. So technically, I'm not really happy with what's going on right now, but it could be an attempt, a final attempt to accumulate shares before another run up. This has been a strong stock. I think a couple areas or a couple things technically to point out here would be, number one, that huge volume that came in that I just talked about on this push to the upside. That to me suggests accumulation. The stock was at 30. A week later, it's at 45 on that kind of volume. Tells me that there's a lot of interest in the stock. Now, it doesn't mean that we can't just fail and go back down, but I do think that the reward to risk is solid at this level. So the only other thing I would draw in here, again, final line in the sand is that low from back in the, looks like maybe around March 14th or so. Don't want to violate that to the downside.
All righty. Let's see. Let's look at one of those ETFs, the Spider Fund, XLRE. What are you thinking about real estate right now?
Well, it's taken a beating, but I'll put up on a regular chart because I think we had a negative divergence here that never really, I mean, as we kept moving up here, you can see it started to roll over. You could go all the way back here to the beginning and draw the negative divergence, lower PPO, higher prices. I tend not to go back that far because the PPO is based on the difference between 12-day and 26-day EMA. And so anything beyond 26 days, and you're not really comparing comparable data sets. So I just don't like to go back that far. But even in the short term, on the latest push to the upside, you can see that the PPO was rolling over again. So I think to pull back to that 50-day moving average is something we hadn't seen since we broke out above the 50 back in January. I don't see that as a problem. I would start to get a lot more concerned, though, if we lost 35 on a closing basis. That was your breakout back in the second week of March. We went back, tested it, moved higher. I think we could be testing it again, but I suspect we'll rally off of that level. So I'd look for some decent support coming in at 35.
All righty. Let's see. How about First Solar, FSLR?
Yeah, we've talked about the renewables, and First Solar has been one of the better ones. A really nice gap up and move higher about a week or so ago, a little over a week ago. I think it continues to strengthen after coming down, getting that 50-day test, having the PPO reset near that center line. What I see now is a move to the upside, PPO accelerating. I think we got a lot of bullish momentum. The only thing I would say is that the stock is overbought, and we're going to get a pullback at some point. Top of gap support is one level I would watch. Bottom of gap support is the other. And then, of course, in between both, we have that rising 20-day moving average. And with a strong PPO, that should really hold. I would not necessarily be looking for it to go all the way back down to fill gap support. I would say 57 to about 58.5 is going to be really good support on a pullback for First Solar.
All right, sounds good. Let's see, how about IVZ Invesco, our only financial request?
All right, I'm going to pull this up on a relative basis because I wanted to see how it's performing relative to some of these other areas. You can see the asset managers finally cleared. I think this is a bottoming reverse head and shoulder breakout to the upside. Like to see it hold about 190 on this pullback, but IVZ relative has been strengthening. So the overall group starting to show strength. This stock has been strengthening against it. So I could make an argument to own it. But because if the group rolls over again, you want to be careful. So I'm going to keep a fairly tight stop. But I think the breakout level and that 20-day moving average almost identical. They coincide at about 2040. So that's a level I'd watch to the downside. Close below that level, I'd be a little bit more nervous. And with a stock that's in a group that's outperforming, I would maybe be, willing to give it a little bit more room. But in a group that has been underperforming, if we start to see that underperformance kick in again, I don't think this is a stock that I'd want to own on a breakdown. So that's all. I would just try and keep a fairly tight stop here.
All righty, let's see. How about a materials sector? Berry Plastics, BERY.
Yeah, beautiful breakout here. I think this is one you had said was on your setup list a week or two ago. And what I look for are, again, stocks that are moving up not only on an absolute basis, left to right across the chart, but also on a relative basis. Now, we have seen the overall group pulling back against the S&P 500 of late, but I would say as long as it holds this December low, I'm okay with it, because I think you've got a higher high, higher low, higher high, triple top, and now as long as we keep that higher low in place here, I'm okay. When I look at the stock relative to its peers, it's a total outperformer. So I like the stock, but I'm a little concerned about the group maybe trying to roll back over. So there's your relative breakout, which I like. I think maybe on an absolute basis, watch this double bottom down here, make sure that holds. Then maybe on a relative basis, make sure this December level holds. But overall, I think this is a great stock. Here was an example of a breakout, heavy volume, pulled back, held that area of the breakout, and then we broke out again. So I would simply say the 20-day moving average and this price support around 56, as long as that holds, I think you got a pretty good stock here with BERY.
All righty. Let's see. How about next one? We'll do IQ. And we won't talk about IQs.
Good idea. Especially having Tom McClellan on.
Yeah.
I would feel maybe a little bit slighted after listening to the presentation. We don't want to go into my IQ after that. Anyway, yeah, the stock was showing some pretty good relative strength heading into the end of February. Since then, it's been back downhill, and it's in a group that is actually starting to show some strength. So this bothers me a little bit in that it's not been one of the better performers. You've got some gap support that we filled, held. I really think these recent lows need to hold. So the annotation here for me, based on what I'm seeing on the chart, is that I really do not want to see a close back below about 22.25. We are failing at the 20-day moving average, so we've been trending lower. I'll give it just a little bit of room because of this huge gap up in big volume, but overall, I'm going to have a tight stop because if it breaks down here, given what's happening to the stock on a relative basis, I don't want to see a price breakdown. So I would be cautious. This is not one I would jump into. I think that there are others in the internet space that look better. I actually talked about some of those yesterday in the, I think it was under the radar segment that we did. But I like the group. I'm just not a big fan here of this stock.
All righty. This is an interesting new ETF that we haven't looked at. KWEB, KWEB, China Internet.
Okay. Yeah, don't need to use the relative chart here. Yeah, we just put in a higher high. I think the test of the 20-day moving average is solid. We held. We're trying to go back higher. So I think overall this looks pretty good to me. So again, I think if I was annotating, I just want to see a series of higher highs and higher lows. Here was this high. There's your next high up here. So we definitely have higher highs. Let's make sure we hold this reaction low that we came down here. So I think as long as 44 holds, we're good. Now, if you want to keep a tighter stop, then I think you watch this 20-day moving average because we did see the PPO reset. We were at the 50-day moving average. We moved up. You can see the PPO moving up with it. Pull back to the 20-day is totally acceptable during an uptrending stock or ETF like this. So I think it looks pretty good. If we pull back, we go below the 20-day, then I think 44 is possible. And that, to me, is a really important level to hold going forward.
All right. This one doesn't look great on the RRG, but I thought the chart itself didn't look too bad. GOOSE, Canada Goose Holdings, GOOS.
Yeah, GOOSE is starting to make a move to the upside. I'm going to go ahead and pull up the relative chart here because this is in the apparel retail space. The problem I have with GOOSE is notice the apparel retailers have been breaking out to new 2019 highs. I've really been strong over the past 5 weeks or so. And yet during that same 5-week period, even with the strength the last 2 days, we're probably flat on GOOSE. So the relative strength has been the problem. And that hasn't changed yet, even with this push to the upside. So I think what I would be doing is looking elsewhere in this space. I wouldn't totally give up on the stock. It could be long-term consolidating after a huge run that it had, but I would definitely be watching this trend line. We're just about sitting on it right now. I think I'd also be a little concerned with that pullback there, or relative pullback, I should say. And then also the relative weakness versus the S&P 500. Starting to turn up a little bit, but I think we have more work to do here. So not one of my favorite ones out there right now, but maybe one to keep an eye on, see if we start to see some more relative strength build, because the group is definitely showing more strength.
All right. Our last one comes from the healthcare sector, Neptune Technologies and Bioresources, NEPT.
Okay, need to get a breakout here. You can see the pharmas have started to roll back over. This stock's been doing pretty well relative to the pharmas of late, let's say the last 4 weeks or so. But the group relative to the S&P and healthcare was getting hit really hard earlier in the market. It was the worst performing group. And it has been. April's been brutal for healthcare. It's been brutal for the pharmas. So it's a group. I'm not a value investor. I don't try to catch a falling knife. So the overall group would probably keep me out of this stock, especially because we are up against resistance. I mean, this has been a good relative performer, but we have had multiple tops just above 380, and I could even go up to these reaction highs around $4 back in October and November. But on this move lower, we have not been able to get back through this level. So with it currently at 368, coming off a low down closer to 280, I think maybe the run could be closer to the end than to the beginning. So that would probably keep me out of the stock. But the part that really bothers me is just a relative weakness in the healthcare, which is a big surprise. I thought 2019 we would be off to a much better start in healthcare, and that just hasn't materialized.
All right, that does conclude the 10 and 10. Here are the symbols that Tom just annotated. I will have these up in the Market Watchers live chart list at the end of the program. You can find that by going to the blog articles tab and then clicking on the Market Watchers live blog, and the link is right there at the top. You can, if you're an extra member above, you can steal those charts for your own chart lists, etc. All right, time for our final market update. Let's go ahead and see what is going on while we have been having so much fun. All righty, here we go. Here is our candle glance. Well, as you can see, currently the Dow is, pretty much stable right now, sitting almost unchanged, only up about 1 point, little over a point. And we can see S&P 500 is lower. It's still trending lower. You can see a declining tops trend line right here, and it hasn't quite broken out from that. It is down 4.7 points. And then let's see, next up, NASDAQ, mostly unchanged, kind of a volatile morning though. S&P 400 losing, continuing to lose, continuing in a downtrend right now. Russell 2000, we talked about small caps briefly with Tom McClellan, and we are seeing quite a decline in small caps right now as far as the Russell 2000 is concerned. It is down almost 1%. TSX, Canadian markets are higher. Looks like we've got a little tiny breakout right now from the intraday high we had set earlier. TNX, Treasury yields are down. They were up a little bit. Now they're down 2.585% is the current reading. VIX is rising, but we're still only looking at a reading of 1262, which is still in that complacency zone, I would say. UUP only down 1 cent, currently at $26. GLD has dropped in the morning somewhat and is now consolidating sideways, down 28 cents at 120.24. USO is down 0.25% currently, and TLT, kind of choppy trading earlier today. Looks like it might be forming an intraday flag. We'll have to see if we can get the breakout on TLT. Real quick on the sector summary, technology and consumer staples, interestingly enough, are leading up both a 0.5% or more. Of course, staples in the defensive area and technology in the more aggressive area. So interesting to see that split. Healthcare and real estate, both defensive sectors, are down, with real estate down a little over 1% and the healthcare sector fund down 2.64% currently. That's all I have for the final market update. Passing it back to you, Tom.
Okay, yeah, I wanted to take a look at the Russell 2000, first of all, just on an absolute basis. And you can see, because it is struggling today, and I know that question came up earlier for Tom McClellan, but after we started selling off in the fourth quarter of last year, we topped actually in September, late August, early September, on the Russell 2000, really began to decline rather rapidly. The initial bounce took us back up near 1,600, and you can see 1, 2, 3 more tests up around 1580, 1590, trying to get through that 1,600 level. I think that would be an incredibly bullish development if we were to break through. I want you to go back and take a look at the middle of 2015, how we had this similar type of breakdown. First move down, we bounce back up, we come back down to a lower low, very similar to what we're doing or what we just did at the end of 2018. But then we worked our way back up, got close to this overhead resistance, pulled back, and then made a breakout. We did have one, maybe 1 month long move to the downside, but otherwise you can see that really set us off back to the upside again. This pullback that we see here, or maybe here, I'm not quite sure, very similar to what we just saw in March with that pullback. So I think the Russell 2000 needs to get through 1,600. Once it does, I think that's when we could begin to see maybe some outperformance by small caps. Right now, I think we're just kind of bound overhead by that resistance around 1,600. Clearly, because we're so far away from our all-time high, this is a group that's been lagging the S&P 500. But I believe if we get through 1,600, we'll start to see some outperformance there. All right, we are going to go into our final segment, which is Inside the Lines. This is just a segment where we take a look at some stocks in the charts, just looking at the technicals and trying to decipher what these charts are telling us. So, Erin, I'm going to let you start it off. What do you have for Inside the Lines today?
All righty. I thought I would look at the stocks. I know we've had questions in the chat room previously about the stocks that might be interesting with the new 5G technology. And for those of you who aren't familiar, 5G is the next generation of the mobile broadband. And it's eventually going to replace, or at least augment, the 4G LTE connections we currently have. And with 5Gs, where the 5G you're supposed to see, exponentially faster downloads and upload speeds, and that sort of thing. So I wanted to look at the stocks that might be the players, the power players in that area of that technology. And so I picked out Corning, Keysight, Qorvo, Skyworks, and Xilinx. And I would have included Qualcomm, but we talked a lot about Qualcomm already earlier in the show. So I figured I'd look at these, behind those headlines, behind what's going on, what's actually happening on these charts. So I'm going to start with Corning. And this is the daily chart. And, I think Corning looks pretty good right now. And here are the reasons why. Number one, we're getting a PMO buy signal. And look in the thumbnail. It's pretty obvious here in the thumbnail. We had a flag and we busted out of it. We're kind of consolidating right now. We haven't been able to get above the overhead resistance that was formed back in early March, late February. But we still, even if we can get that breakout, and you can see we had a tiny little pop above that area today, an intraday. But I would look for at least a 2.5% move to test this overhead resistance at that September top, and I believe all-time high. And I say that because I see some positives on this chart. So as far as the shorter term goes, I think this looks pretty good. But let's face it, if we're talking about the development of a technology, probably want to look at a weekly chart. And Corning was one that I did pull up a weekly chart. I thought it looked interesting. We can maybe look at a few depending on time. All right, so here's the weekly chart for Corning. And look, we've already gotten the buy signal. It came in earlier in 2019. I think this stock was already showing some strength, relative strength that's really coming back since that low. you know, so behind the lines here, I think this one already was looking pretty good in that space, just on its very own. So I'm looking for a challenge of that all-time high. Actually, the all-time high wasn't back here. It was back here in, well, I guess no, that was September. So it is the all-time high. I'm looking for a challenge of that. And I think that over time, we'll probably see a move past that all-time high as well. But, you know, the stock market, it would be good to see the S&P to get that decisive 3% breakout above all-time highs. I'd feel a lot more comfortable. But you know, honestly, this, I think that Corning looks pretty good inside the lines. Keysight Technologies was another one I picked up in the electronic equipment space. I really actually like this one, and I know everybody would be, why? Here's the thing. So it went into this wedge. Oops, I'm sorry about that. It went into this rising wedge, which is a bearish formation. It's absolutely getting stung today. It is down almost 2.25%, but it's coming down some really important support here. And even if it does fail there at the 20, I would still keep this on my watch list, because the next area is 82.50. And, you know, if this truly is going to be one of those stocks that does very well in the development of this new technology, these are some areas that might be good to get in. Here's the problem, of course, why I wouldn't do this right now. Number one, you can see even just today's trading, it's still making new intraday lows. So, and below the 20-day EMA. We're getting that pullback. We always talk about getting the breakout and then wanting the pullback, and here it is. PMO, we do have what is called a bear kiss. It sort of fakes out the bulls right here, and then it turns back down. And so we do have a top below the signal line, which I don't like. But OBV is still looking pretty good here. And of course, the scooter has been, you know, it's been the leader, one of the leaders in the large caps here with that it is in that space. So I would add this one to a watch list as well. And let's look just quickly at the weekly. And here we go. All right, so you can see this overhead resistance is going to be a bit tough here. Oh, this is Ford. Why I don't want Ford. Let's get back here. It's like that doesn't look like the right chart. And that's not it either. It should be keys. There we are. Here's that weekly chart. All right. So you can see we've been on the buy signal here. That was a very timely buy signal. It had that breakout, and that's about when it came in. And then it's been just straight off to the races. So like I said, as you can see, we don't have to chase this one necessarily. It might get us down, pull back into that $85 range. Keep it on your watch list. I think this one could be very interesting in that space. Corvo is the next one I have here for us. And this one is in a rising wedge. I am expecting the pullback like we just saw on Keysight. You have a PMO that's trying to top here. It's overbought. This one does need to pull back. We really do need to see it come back down to earth here. And so we're getting a 1.84% move to the downside, but I'm looking for a breakdown. I'd want to see a test here at the support level that I've marked in here. I think I got it from, well, just from this top, I guess. So that's the short-term area, looking for that for sure. I would say I would look for that breakdown to get back to that $75 level. And I'm basing that on the pattern itself and on the top that we're getting right here. We had what looks like a buying exhaustion yesterday. So this one needs to pull back a bit more. Skyworks. Alrighty, it's hit overhead resistance here and has pulled back. Look at the 50, just now starting to cross the 200-day EMA. That puts this in a bull market configuration, which is excellent. Of course, sitting here on a buy signal for the PMO. And like I said, 2.5%, we're getting that pullback. Be nice to see it come all the way back down here and test that support level and move its way back up. So I like Skyworks. It did get downgraded today, so it does have some work probably to do on a pullback. Like I said, I'm looking at that 87.50 area. And then finally, Xilinx, and I know we've talked about this one quite a bit, so I won't get too crazy here. But first of all, look at that scooter. Pretty much has been the leader on that top 10 as far as scooters. Now, this one, I had it already in here. We had talked about it. Oh, I can't remember why. I can't remember why it was in my list, but I had already marked. I thought this was great because I marked this ascending triangle, and it was before it broke out, and then it did. It did exactly what we want. It broke out. Expectation would be a move. Oh, well, it's already kind of made that move. It probably has a little bit more left. Look at the buy signal coming in. And these clean buy signals have been pretty accurate. They may take some time. You notice we had consolidation here and consolidation there before we took off, but I like this buy signal coming in above the zero line. All right, Tom, passing it to you. What have you got inside the lines?
All right, let's see here. I want to go over a few stocks, the highest scooter ranked large cap stocks. And I want to talk about them a little bit more on a longer term basis. So feel free to give me some input at the end based on your decision point. But before I get into that, I just want to point out, because I'm going to show a weekly chart, and I'm going to put the scooter on the chart. I just want everyone to understand, number one, because sometimes when you look at a weekly chart, going from a daily to a weekly chart, if you leave your settings at, say, on a moving average, 12 and 26 or 20 and 50, whatever it is, those moving averages are going to be different based on whether you're on a daily or weekly chart. So a daily chart, if you have a 20 period moving average set, it's 20 day. On a weekly, it's 20 week. Well, on a scooter, I just want you to know that, first of all, the scooter doesn't change. So here we have a daily chart, and you can see Applied Materials 91.7. I moved to a weekly chart here on Applied Materials. It's at 91.7. So things don't change when you go, back and forth like that. But if you notice, the moving averages do. Your 20 and 50-day moving averages are different on the daily and weekly chart. So that's the first thing I want to just point out, because I'm going to look at Xilinx. I know, Erin, you just did, and we've looked at it a lot on here, but it's been one of the best performing stocks in the market. I am going to look at it a little differently, though, in that I'm going to look at it from a longer term weekly perspective, as I'm going to look at each of the top 5 scooter ranked stocks. So on these charts, you can see the scooter. Right now, Xilinx, #1 ranked large cap stock, 99.9. PPO, you can see, has just been off the charts, now at 12.5%, which is just crazy to have a PPO that high. But the stock's been on absolute fire. Now, we could use just about any measure. I don't have overbought, oversold indicators on here. What I do have on here is the rate of change. And I adjusted this. If you go back into the scooter ranks, one of the things that really drives is the 125-day rate of change. That's what drives the scooter. That's 30% of the calculation. The percentage above the 200-day moving average is another 30%. That's 60% of the scooter calculation. So if you want to know why Xilinx has such a huge, why it's the top ranked scooter score, well, look at what's happened with its rate of change. It's because the stock price is just absolutely taken off relative to its moving averages. Even the short-term rate of change, and I used 4 weeks because on the intermediate term, the rate of change is 20 days. Well, on a weekly chart, I have to adjust that to 4 weeks for 20 days. So you can see both of these, though, have been very high throughout 2019, and that's why we're seeing such a big move on Xilinx and why the scooter is so high. Now, when I look at the chart, I just see a stock that's overbought. It may require at some point some consolidation, similar to what we saw in 2014. We were on fire. Scooter never got up to 99, but the scooter was pretty high. It got up to about 90, and then we went into this sideways consolidation. At some point, we're going to see that with Xilinx, but that doesn't change the fact that it is a really strong stock now. As far as some of the...
I was going to say it didn't get hit that hard either on the bear market decline.
No, not at all. It's a relative outperformer. And that's one of the benefits of owning these strong stocks, is that they don't tend to get hit as hard when the market pulls back.
Yep.
All right. Qualcomm, of course, has jumped because of its move the last 2 days. But this one is making a breakout on a long-term basis with this move to the upside. And a lot of uncertainties now are behind this company. I think this is a really important move to the upside on Qualcomm. And you can see that quick jump from a scooter that was down in the teens to one that is now at 99.7. And the reason, a huge rate of change jump that we can see not only on the short term, but also on that longer term as well. All right, just three more real quick. We'll go through CDNS, another, here's you go. There's that high scooter score, 99.5. As we look, PPO very overbought. CDNS has been on a roll to the upside. We saw this in 2017, went through sideways consolidation though, and then eventually broke out again. The reason I'm bringing some of this up, these are great companies. They've been performing really well. But if we start to see failures, you do want to at least be aware that sometimes you get these readings, and you can see CDNS had a high 90s reading on the scooter back in 2017. But during a consolidation phase, it pulled back. Chart didn't break down really, just went sideways for a bit. But it did move much lower on the scooter. And then CMG, which is Chipotle. Remember all the problems Chipotle was having? Look at the scooter score down near 0 for a while. Now look what's going on. The scooter has remained up near that 100 level, 99.4. Looks great technically, but overhead resistance at 750. We want to watch this. They'll be coming out with earnings. We'll see whether or not we can take out that 750 level with earnings coming up. And then the last one is MSCI. This is I think in specialty finance. We've talked about this one recently, 99.2. Another one that went through a period of a weakness after it had scooter ranks in that 90, 95 area. But after being weak for a while, came storming back and quickly moved back up among the top stocks. So I don't know if any of those struck your fancy there, Erin, looking at the longer term charts, but they're all healthy technically at this point. But you do have to recognize that sometimes when these stocks perform so well for so long that they could go through a period of consolidation, something to think about.
Absolutely. And I meant to show an RRG of those 5. The RRG isn't all that impressive with the 5 that I was looking at.
Yeah. Well, I mean, you go through periods, especially if it's a daily RRG. We could, see
yes.
the position, back and forth. You go into weakening, and then all of a sudden you're back up into strong again. I know we've seen that with Xilinx. Xilinx struggled for a brief period and then came roaring right back. And that's the sign, as I'm sure Julius will talk about tomorrow when he joins you. But that is a sign of pretty good action in the market when you just go into the weakening for a period of time and then shoot back into the leading again. All
righty. Let's see. I can't believe it. The show is almost over again. Should we look at the poll?
We can pull up the poll. I think the poll was wondering about the blogs. We did make some changes recently to Chart Watchers, which I think certainly is worth mentioning. If you don't already subscribe to Chart Watchers, you certainly want to. Yeah, I mean, well, we'll get that poll up here in just a second. There we go. Yeah, let's talk about the blogs. How often do you use our blog area? Almost half of you use it daily. That is awesome. I would like to see it go up to about 99%, but 49 is not bad. A few times a week, I mean, between the two, we're looking at better than 3/4 of our audience that responded. Look at it at least a few times a week. I think that's pretty cool.
Yeah, I'm surprised. I'm not surprised, but I've never used it. You 3%. It's free. It's a free place to go, and you can read commentary from lots of us. So I recommend you at least check it out. And of course, the Market Watchers Live recap is in there. So you can find out what the show included with timestamps. If you want to go back on YouTube and watch it, there's links, all of that.
Absolutely. All right. Upcoming schedule you can see on your screen. I do want to mention I will not be here tomorrow, but Erin has an excellent, awesome substitute coming in Julius DeKempenaar. He's going to stay the entire day, so I'm sure that will be an excellent show. You'll want to tune in for that. I do want to thank all of you for being with us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. And I'll see you back here next week. Erin and Julius will see you back here tomorrow. Happy trading.
Hi, this is Arthur Hill with a quick shot. Today we're going to show you where to find symbols for breadth indicators. The first and perhaps the easiest place to find your breadth symbols is simply at the top of every web page. You have a symbol entry box there, and if I start typing in the word advance, you can see that I'm going to get an autofill there and a number of suggested terms. And there I have a term for advanced decline issues, advanced decline volume, and right there you can find a breadth indicator if you know the name. For instance, if I want to look for bullish percent indexes, I have bullish, and then I start typing in percent, and you can see everything fills out. If I want to know more or find more bullish percent indexes, I just click on the bottom there for more results. And there I will see all of the bullish percent indexes. If I know the keywords that are part of an indicator name, I can search for those keywords, and I can join those keywords with the term and. And when you join a search term with and, in other words, two words, those words must be included in the name of the symbol. So what I'm going to do is I'm going to open up the search box at the top right, and I'm going to search for advance and decline and percent. So that means all three terms must be included in my results. Now you can see I don't have any symbols here, and that's because I'm looking at support articles. But if I click that drop down there, I can choose to show me symbols related to advance, decline, and percent. And here you can see I've got a number of breadth indicators based on advance, decline, and percent. We do these breadth indicators for a number of major indexes. We do them for the 9-sector SPDRs, and as you can see there, we do it for the Gold Miners Index, ETF. Next, the other group of breadth indicators that I would like to show you would be the high-low percent indicators. So if I search for the term high and low and percent, click enter, you can see all the indicators based on high, low, and percent. Now say you're just interested in new highs or new lows. Well, you could just change this search term to new and highs. And you can see we're going to get just new highs in those search results. Well, there's one more term that I would like to show you that you can search for. It would be stocks and above. And when I search for those two terms, you can see the first results are not applicable. But if you go down a little bit, there you can see we've got some breadth indicators appearing. So we have the percentage of stocks above the 200-day EMA, and then we have the percentage of stocks above the 20-day and the 50-day. And if you go next, you can see the rest of those results. So those are some indicators that you can use to measure the participation within an index. And one more term that I'll show you would be the advance decline line. So I'm going to search three terms, advance and decline and line. And when I get those results, there you can see a number of advanced decline lines that are available. Now what's great here is you can see the icons over on the left. Well, you can click one of those icons to get a chart. So the furthest to the left is the sharp chart icon. So if I click on that, I will be taken to a sharp chart based on my default chart settings, and it will show the S&P 500 advanced decline line, which was the symbol I just clicked there. So immediately you get a chart with that indicator you're looking for. So you can see here that I've searched for the term Hindenburg, and I've got three results for the Hindenburg omen. And what I want to point out is the symbols there. They begin with exclamation point BI, breadth indicator. And if you search that term, exclamation point BI, then you're going to get all the symbols that begin with exclamation point BI. And this is very important because These are all the symbols or breadth indicators that were developed by Greg Morris. We also have breadth indicators from Decision Point in this group. There are dozens and dozens of breadth indicators here for you to work with.